It's October 2025, and the mood in the air feels tense. The world is watching closely as economic uncertainty grows, and the word recession is once again making headlines across the globe. Recession fears are back in the headlines, dominating news cycles and sparking debates among experts and everyday people alike. The International Monetary Fund has raised the odds of a U.S. recession to 40% and cut its growth forecast, signaling a more cautious outlook for the months ahead. Even typically optimistic firms like Goldman Sachs and J.P. Morgan are sounding the alarm, putting the risk at 30–40%. That's a significant shift from their earlier, more upbeat predictions. The global economy is flashing real warning signs, especially fragmentation, which the World Economic Forum warns could shrink the global economy by a staggering $5.7 trillion over the next few years. That's a bigger hit than the 2008 crisis, which left deep scars on businesses, families, and entire communities. We're seeing a world that's less connected, more divided, and increasingly hostile to global trade. Supply chains are disrupted, and international cooperation is under strain. This isn't just theory, it's real, and it affects your job, your savings, and your future security. Everyday people are feeling the pressure as costs rise and opportunities shrink. So what does this mean for you? You can't just hope for the best and wait for things to improve on their own. You need a plan to protect your wealth, your livelihood, and your family's well-being in these uncertain times. There are proven strategies to get through economic uncertainty, from diversifying investments to building up emergency savings and seeking expert advice. This isn't the first time we've faced tough times, and it won't be the last. History shows that those who prepare are the ones who come out stronger. The key is to be informed, prepared, and ready to act. Let's get you ready to face whatever comes next. Here's what you need to know to navigate these challenging times and protect your financial future. We hear the word recession all the time, especially when the economy seems shaky or the news is full of gloomy headlines. But what does it actually mean? And why does it matter to everyday people like you and me? A recession is a significant, widespread, and prolonged downturn in economic activity, usually defined as 2 consecutive quarters of negative GDP growth. In other words, the economy shrinks for half a year or more, and that signals trouble. GDP, or gross domestic product, measures the value of everything a country produces, from goods to services. If it shrinks for 6 months, that's a red flag for economists and policymakers. But a recession isn't just a number on a chart. It's layoffs, rising unemployment, and people spending less money on things they want or need. Businesses start cutting costs, which can lead to even more layoffs. A vicious cycle that can be hard to break. It's a crisis of confidence that makes the slowdown even worse, as fear spreads and people hold back on spending and investing. Recessions are a natural part of the economic cycle. Economies expand and contract over time, just like the changing seasons. The goal isn't to pretend they'll never happen, but to be ready and resilient when they do. Understanding what a recession is helps you prepare, make smarter decisions, and avoid panic. It's not a monster under the bed. It's a known risk that you can plan for and manage. And when you know your enemy, you can defend against it, taking steps to protect your finances and your future. So let's take a closer look at what's causing today's worries and how you can stay informed and prepared. Transition to next scene. Why are recession fears so high right now? The world economy feels like it's teetering on a knife's edge, and everywhere you look, there are warning signs flashing red. Investors, business owners, and everyday people are all asking the same question. What's causing so much anxiety in the markets? It's a triple threat: tariffs, supply chain chaos, and political instability. These forces are colliding at once, creating a level of uncertainty that hasn't been seen in years. Tariffs, taxes on imports, are back in force, especially between the US and China. The world's 2 largest economies are locked in a tense standoff, with each new round of tariffs escalating the conflict. The IMF says these tariffs could push US inflation up by a full percentage point, making everything more expensive, from groceries to electronics. For families already feeling squeezed, that's a big deal. Trade disputes are spreading uncertainty everywhere, not just between two countries. Global markets are reacting with wild swings, and businesses are struggling to plan for the future. Canada's recovery depends on avoiding new tariffs, and bizarre levies on things like solar panels are making headlines. Even industries that seem safe are now caught in the crossfire. This isn't free trade, it's a trade war, and everyone loses. No one is immune from the fallout, whether you're a small business or a global corporation. Supply chains are breaking down, factories are idling, shipments are delayed, and companies are scrambling to find alternatives. U.S. cargo shipments have dropped by 60% since April. That's a staggering decline, and it's rippling through the entire economy. Major retailers warn of empty shelves and higher prices. Shoppers are already noticing the difference, and the situation could get worse. Political instability is making things worse. Government shutdown threats in the U.S., a surging euro in Europe, and slashed growth forecasts in Asia. The world's major economies are all facing their own crises. It's a perfect storm of economic, trade, and political headwinds. The risks are piling up, and the outlook is more uncertain than ever. That's why experts are worried, and why you should pay attention. Understanding these risks is the first step to protecting your finances. So, how do you protect yourself? Let's talk about gold. Transition to next scene. When markets get scary, smart investors turn to gold. Gold is the ultimate safe haven asset, a financial parachute when everything else is falling. It's a physical asset with value recognized worldwide, not tied to any government or company. When uncertainty rises, people lose faith in paper currencies and stocks, but gold often rises. It's a hedge against chaos, inflation, and geopolitical risk. Gold isn't about getting rich quick. It's about long-term protection. It doesn't pay dividends, but it preserves wealth when other assets drop. You can buy physical gold or invest through ETFs for easy access. A small allocation, 5 to 10% of your portfolio, can buffer against economic shocks. That's why gold is a classic defensive move. But gold isn't the only tool for stability. Let's talk about bonds. Transition to next scene. 14. If gold is your insurance, bonds are your anchor. Buying a bond means lending money to a government or company in exchange for steady interest payments. High-quality bonds, like U.S. Treasuries or top-rated corporates, offer reliable income, especially when stocks are volatile. During recessions, bond payments keep coming, cushioning your portfolio. Bonds often rise when stocks fall, smoothing out your returns. Stick with high-grade bonds for defense. Avoid risky junk bonds. You can buy individual bonds or diversify with bond funds and ETFs. A healthy bond allocation is like shock absorbers for your investments. It won't prevent bumps, but it makes the ride smoother. Now, what about stocks? Let's see which ones can weather the storm. Transition to next scene. Don't ditch stocks entirely. Even in a recession, some hold up well. Focus on defensive stocks. Companies selling essentials like food, utilities, and healthcare. People need these goods and services no matter what. Consumer staples, like Procter & Gamble, utilities, and healthcare firms have stable demand and often pay dividends. These sectors offer predictable earnings and tend to fall less than the broader market. Rotating into defensive stocks lets you stay invested for the recovery without wild swings. Analysts still see long-term potential in the market, with S&P 500 targets remaining high. Shifting to defensive sectors is smart, not panicked defense. But don't put all your eggs in one basket. Let's talk diversification. Transition to next scene. 12. The golden rule. Diversify, diversify, diversify. Spread your money across different assets, industries, and regions. If one part of your portfolio gets hit, others can soften the blow. Trade wars, inflation, and market volatility can strike anywhere. Don't let a single event sink your whole portfolio. Diversify by asset class, stocks, bonds, gold, and by geography. Global fragmentation means you can't rely on one country's economy. International exposure protects you from regional downturns. Build a mix of stocks, bonds, and alternatives like gold or real estate. Diversification is your best defense against the risks you see and the ones you don't. So, what does a defensive portfolio look like? Let's sketch a sample playbook. Here's how a defensive portfolio might look in 2025. Start with balance. A mix of assets for both protection and growth. Allocate about 40% to stocks, focusing on defensive sectors like utilities, consumer staples, and healthcare. Keep a smaller position in growth stocks for long-term upside. Dedicate another 40% to high-quality bonds, U.S. Treasuries and investment-grade corporates, for steady income and stability. Add 5–10% in gold via ETFs as your chaos hedge. The remaining 10–15% goes to international stocks for geographic diversification. This approach, defensive stocks, bonds, gold, and global exposure, helps you weather uncertainty. It's not about avoiding risk, but managing it wisely. Let's wrap up with some final advice. Transition to next scene. 13. The outlook for 2025 is uncertain, but panic isn't a strategy. Don't sell everything and hide in cash, especially with inflation rising. The goal is to position yourself to win in any market. Recap. Understand the risks, but don't freeze. Diversify across assets, sectors, and regions. Gold is your insurance policy. Bonds are your anchor. Defensive stocks let you stay invested for the recovery. Economic cycles come and go, but opportunity is always there for those who prepare. The strategies we've discussed, gold, bonds, defensive stocks, diversification, are timeless. Stay alert to economic changes, stay smart about your portfolio, and most importantly, stay invested for the long run. Now, go do your homework, and get ready for whatever comes next. End. 15.